A ceasefire was declared. Oil prices fell. The S&P 500 logged its seventh straight day of gains, its longest winning streak since October. And on Thursday, exactly 5 ships crossed the Strait of Hormuz. 5. Before the war, between 130 and 160 ships passed through every single day. That gap is the story. Iran agreed to a minimum of 15 ships per day during the truce. It delivered 5. The reason is structural, not accidental. Iran minister told ITV that every vessel still requires military approval before transit, so crews can be told where to avoid the mines. The strait is nominally open and operationally closed, and Iran is charging tolls in Chinese yuan or cryptocurrency, turning a choke point into a revenue stream. Tehran didn't just fight a war, it changed the rules of global shipping. That shift doesn't reverse when a ceasefire is signed. The mines are still there, the approval regime is still there, and Iran knows that controlling the strait is now its most powerful negotiating chip heading into formal quiche talks starting Friday. The energy market has started to price that in, but only partially. Brent crude settled near $96 Thursday, down from $108 at Tuesday's peak, but still far above pre-war levels. The airline industry is more direct about the math. The head of the International Air Transport Association said jet fuel supply damage is comparable to 9/11 in scale, and that even if the strait fully reopens, it will take months before refining capacity and fuel prices normalize. Thai Airways CEO called this the worst oil shock in his nearly 40-year career. The longer-term pressure is already moving into food markets. The strait carries roughly a third of internationally traded fertilizer. Natural gas, which determines 70 to 90% of nitrogen fertilizer production costs, has seen a 20% drop in output from the conflict zone, with price spikes up to 70%. China has blocked phosphate exports, removing 25% of global supply. In the US, some fertilizers rose more than 40% in a single month after the war began in late February. Corn yields reduced by 10 to 15% if nitrogen application falls, and the season's window for application is narrow. The food price surge has a lag, but the trajectory is already locked in. What determines the forward path is simple. Does the strait actually open, or does Iran continue to use it as leverage? If formal talks produce a binding shipping agreement by end of April, crude has room to further fall and airline stocks recover. If talks stall and Thursday's ship count suggests Iran has no urgency, oil above $95 becomes the new floor. Fertilizer shortages extend into the planting season, and food inflation arrives in consumer prices by late summer. The inflation data that hit Thursday was already outdated before it was released. Core PCE, the Federal Reserve's preferred gauge, came in at 3% for February, before the oil shock, before the energy price surge, before the fertilizer crunch. It was in line with forecasts and offered no relief. Core PCE has now been stuck near 3% for 3 consecutive months. On a 3-month annualized basis, it's running at 3.7%. That number was described by RSM's chief economist as not painting a flattering portrait of an economy on the edge of war. The Fed's target is 2%. The gap is not narrowing. At the same time, GDP growth for the fourth quarter of 2025 was revised down again to 0.5% annualized from an initial estimate of 1.4%. Personal income fell 0.1% in February, while spending rose 0.5%. That combination, weak growth, falling income, rising prices, is what economists mean when they say stagflation. One strategist at TradeStation said the parallels to the 1970s may be growing. The Fed minutes from March, released Wednesday, showed officials worried about both sides of their mandate, but leaning toward rate stability, not cuts. And now the calculus is shifting further. Cleveland Fed President Beth Hammack said directly that a rate hike is possible this year if inflation stays persistently above target. Chicago Fed President Austin Goolsbee had earlier put it plainly, rate increases have to be on the table. Futures markets still assign less than 1% odds to a hike, but 2-year Treasury yields are already trading above the effective Fed funds rate, a signal that bond markets expect the rate to go higher, not lower. Friday's March CPI report is the next pressure point. The Cleveland Fed's own model estimates headline inflation jumped 0.84% month-over-month in March, driven by the energy shock. If confirmed, that would push the annual headline rate to roughly 3.3%, nearly a full percentage point above February. A reading at that level forces a reckoning. The Fed either signals tolerance for prolonged above-target inflation, risking credibility built over 5 years, or it acknowledges the hike debate is live, which immediately reprices risk assets. There is one structural complication that makes this worse than the 1970s analogy might suggest. The AI investment wave sweeping through the economy, Amazon committing $2 billion in data center capex for 2026, Meta locked into $35 billion in cloud contracts with CoreWeave through 2032, is generating demand that pulls in energy, construction, and skilled labor simultaneously. That demand doesn't pause for a ceasefire. It competes directly with the energy supply already constrained by the strait closure.
The weight of evidence leans toward rates staying higher for longer. Not one cut, not two cuts. The probability of a hike by year-end is still low, but it is no longer theoretical. The scenario that changes this picture is a confirmed functioning reopening of the Strait combined with a March CPI reading that comes in below the Cleveland Fed's 0.84% estimate. If both arrive together, the hike narrative fades. If CPI confirms the energy pass-through is real and Hormuz remains functionally closed, the Fed's next move becomes genuinely contested, and markets have not priced that in.
While oil prices surged and inflation data disappointed, a different economic signal was moving in the opposite direction. Amazon CEO Andy Jassy published his annual shareholder letter Thursday, disclosing that AWS AI services now generate over $15 billion in annualized revenue, a figure that caught many analysts off guard. Amazon stock rose 5%. That same day, Meta confirmed a $21 billion expansion of its cloud deal with CoreWeave, bringing Meta's total committed spend with the company to $35.2 billion through 2032. CoreWeave's total contracted revenue backlog reached $66.8 billion, 342% growth from the start of 2025. This spending is not slowing. Amazon plans approximately $200 billion in capital expenditures for 2026, nearly all directed at AI infrastructure. Meta intends to spend between $115 and $135 billion this year. Jassy's framing was unambiguous. AI is a once-in-a-lifetime opportunity. We're not going to be conservative in how we play this. The structural constraint underneath this race is GPU scarcity. Even inside NVIDIA, research teams cannot get enough chips. Brian Catanzaro, who leads applied deep learning research at NVIDIA, said his team's primary complaint is that they want higher GPU limits, and that Jensen Huang tells him directly, "I'm sorry, Brian, but those are sold." The company that makes the chips powering the entire AI build-out is itself supply-constrained on its own product. This creates a compounding effect on energy demand. Data centers require power. Power requires natural gas. Natural gas supply is down 20% from the conflict zone. The grid constraints limiting data center expansion, already flagged by energy analysts before the war, are now competing with a constrained fuel supply. The AI investment wave is generating demand that the current energy system cannot easily absorb, even before the Hormuz closure is factored in. The verification point for this chapter is Amazon's Q1 earnings and AWS growth rate due in late April. If AWS growth sustains above 20% while CapEx guidance holds at $200 billion, the AI spending cycle is confirmed as durable regardless of macro headwinds. If energy costs force a revision to data center expansion timelines, the capital commitment numbers become the next overhang on tech valuations. The ceasefire rally in equities, the inflation data, and the AI spending surge are not three separate stories. They share one underlying variable: whether the energy system recovers fast enough to support the demand that AI infrastructure, food production, and aviation all require simultaneously. Right now, 5 ships per day say it isn't.